All right, that is the timer. We will switch back to the main camera and we are good to get started. So, thank you guys for tuning in. For those of you who are watching live, to our early Sunday stock market scan as we talk about what happened in the past week of our trading and what our plan is for the upcoming week as far as trading is concerned. We've got a very, very potentially volatile week in the market. So, there's definitely a lot to talk about, especially looking back and what happened last week and learning some lessons from that. But without further ado, not much else to say beyond that. But let's jump into it. So we'll go back to the normal one. Put myself back in the corner. There we are. Let's get it started. So high level, we made about 100. Not about. We made $116 in the market last week. And I guess elephant in the room, the reason that we're not happy about that is because the market was continuing to rip. The S&P 500 went up 2.48% and Nasdaq was up 4.32%. And for those of you who have been following the market, following the S&P 500, following Nasdaq and understanding how those typically move, that's a massive, massive, massive week. But what's even crazier is if we look back, for the first few weeks of 2023 so far, we'll see that Nasdaq made money last week, was up an additional 4.82% the week before that, and then 1% in the first week of the year. So all in all, we are definitely falling behind a little bit here in our relative outperformance chart. But big picture, it's important to keep a little bit of perspective, right? The first of which is the fact that Nasdaq is up. What's the number we've got it at? 11.04% so far this year. That is a huge, huge jump for just 1 month, and that basically puts it on track to make like 200% or something crazy like that over the course of the year. So big takeaway there is that rate is not going to continue. At some point, things are going to fall back. And this will level itself out a little bit. We're not going to outperform every single month, but the goal with this strategy is in the months where the market does run away a little bit like this, we at least kind of want to keep level with it. And we've done that a little bit with the S&P 500 as it returned 6.08%, and we finished up at 4.83%. So we're kind of there. And one thing to keep in mind here is this 6.08% return, and we remember it's even bigger for Nasdaq. How do typical months in the market look, right? The S&P 500 6.08% in January of 2023. If we take a look at 2022, we see that there was only 2 months that were, had greater returns than that. So it's really, really outpacing stuff. And 2022 mixed in with these two really good months were some very, very red months. So we want to stay patient. Things aren't going to go up forever. And typically it's those times where the market feels like it's never going to stop going up that it tends to turn back around. And that's when a lot of people get crushed. But even looking back at 2021, right? Excuse me. We remember that 2021 was a really, really good, easy year in the market. It did not have a single month that returned more than 6%. So what we saw in January 2023 would have individually been the best month in the S&P 500 for all of 2021. So again, point being, keep that larger term trend in the back of your mind, keep some perspective because things are moving very, very quickly and very, very largely, if that is correct grammar. So the other thing that I want to keep in mind here as well is the fact that yes, a lot of the time when the market moves up like this, it helps our positions. But in the back half of the month, if we remember what we've been trading, a lot of our portfolio, and even going forward into next week, is bearish position. So this move upwards in the market actually hurt us. So we're not getting these returns because of we're not at our 4.83% return because of the fact that the market is up. In fact, we have made more money if the market went down. So we're going to continue to position ourselves as such. The market as a whole is getting really, really overbought. There are a couple potential downside catalysts coming up this week, and we want to be prepared for that. But now that we've got a little bit of perspective, right? My favorite thing for perspective is taking a look at our performance since inception. We're way up here still. We're at all-time highs. The S&P 500 and Nasdaq are very, very far away from those all-time highs. And since we've been publicly tracking our trades, we have outperformed Nasdaq by 132% and the S&P 500 by 115%. So we are trailing currently this year by 1.25 and 6.21% respectively. But we'll remember there was also a recent January 2022 where we were underperforming those two as well. If we go to that year-to-date summary tab again, we'll see that through the beginning of the first month, We were trailing the S&P 500 by 14.4% and trailing NASDAQ by 10% last year. Again, at the end of last year, what do those numbers look like? We stuck to our plan, we stuck it out. And the reason we were trailing that so much through the first 3 months, if we scroll back over to left here, is because we were down a good $38,000 at the end of January. So we're trailing slightly, but the difference this year is we're up like $8,000. There it is, $8,500 in January. So good start to the year. We're going to kind of run our own race here a little bit as the market runs away. We know it's going to come back at some point, and we don't want to get caught on the wrong side of that move. So if we can continue, even if our weeks are a little bit flat, right? As long as we just keep making money every single week in some way, shape, or form, I'm going to be satisfied. So let's talk a little bit about last week in particular. We did underperform pretty significantly. However, we had all bearish positions basically, and we still made money even though the market ripped. I think that in and of itself is a pretty solid accomplishment. Spotify, the first one on the list here, lost a couple $100 on that one. This is when we started playing. If you take a look at Spotify a couple weeks ago, I think, there we go. We started January 13th expiry. So it's been a couple weeks of trying to short Spotify back down. We started with 92 strike calls. And if we flip over here, we could take a look at Spotify itself. And you'll notice that over the past month, if we rip this chart up, when we started trying to play it back down from this 92 level, it actually breached and went all the way up above 100, 104.36 at the peak. But despite the fact that we started playing it bearishly here and it closed last Friday above 100, in aggregate, we made 105 on that initial trade. The two trades we took after that lost us a little bit of cash, and then the two we had last week all sum up to a $292 loss. So we are going to lose sometimes with this strategy. We're not going to lose a lot. It's going to be in the minority of trades that we're losing. But the biggest thing we could do is make sure that when we do lose trades, that we minimize the magnitude of the loss. And doing that here, only losing $292 on Spotify, despite the fact that it ripped upwards against us, I think we've accomplished that goal there on that trade. So even though we lost the trade, it's okay. You know, we managed it well, I thought. One thing in particular that we did was this 96 strike call. You'll notice if we zoom in a little bit more to the 5-day chart here, what you'll see is the 90. Let's go back. What was it? The 96 strike call when on Thursday. This is Thursday right here when Spotify was trading at about this $100-ish level. That 96 strike call didn't really have any extrinsic value left on it. So what does that essentially mean? It essentially means we basically have just a short position where we don't benefit below 96. So we wanted to roll that up and protect ourselves on the upside, right? We knew the trade was a little bit of a loser, but the good part about this is we could protect ourselves on the upside, minimize the magnitude of that loss. So we rolled up to a 101 strike call, which did also lose money, but had we held on, right? Had we still held on, with Spotify closing at 102.24, this 105 loss that you're seeing right here would be 102.24 minus that 96 strike. It would have been a $269 loss. So we saved ourselves a little bit of cash right there by rolling that thing up. So even though it lost money, I think we managed it properly. We did well there and minimized the loss. Because then when the market's ripping upwards, we always like to have a couple bullish positions because in general, we think in the long run, the market's going to be bullish. Unity and Ford fit the bill for those two. We got out of those with $650 of profit, so that was nice. Win, the 100 strike call, similar to Spotify. We've been rolling this one week after week after week. Let's see where we started this one at. We started this last week, or did we do it 2 weeks ago? 2 weeks ago is when we started this thing. We started shorting it at 97 with 97 strike calls, right? Excuse me. So if we pull up Win, we go to the 20-day chart. Very similar story. Didn't quite run up as much as something like Spotify did, where this kind of got above that initial level we are trying to play it below. This had a little bit more muted of a move. But again, why are we playing these stocks back down? We go to the 1-year chart. This is the answer right here. It's this RSI, which is red hot, right? 72.58. Anything above 70 is overbought on a stock, and typically a pretty good indicator that it might pull back a little bit in the near term, right? Last time we saw RSI get up this high, it crept a little bit higher, the stock price, but in the short term, dipped right back down to 80. Now, that doesn't preclude it from running back up past that, but the idea is so long as RSI is above 70, we're going to continue to play it back down until we get that initial red candle, or at least a little bit of chop, right, to bring it back down to this 60-ish level, and then we get back out of that trade. But right now, it's still above 70. We're staying in it. And if we look at this on a week-to-week basis, right, we started with those 97 strike calls. We rolled to 98 same week, right? That's an $11 loss on the week, even though it moved against us. That's very, very immaterial. We go to the next week after that. We roll to the 99 strike call. What do we do with these, right? We remember with cash secured puts, we want to roll down and out for a credit. With these naked calls that we sell, we want to roll up and out for a credit. Up and out raises the break-even price on a bearish position, which is what we want. So the next week we did that, and it made us 139 bucks. So in aggregate, this trade's profitable by 128 bucks. That takes us to last week. We had win, moved against us a little bit, right? But let's remember, in aggregate, we're up $88 on win right now. But if we think about what's happened over the course of this trade, we go back to the 20-day chart. We started playing it down right about here. And it's moved up against us. It's moved against us, has breached $100 a share, yet we're still profitable on it. And that's the value of selling premium on names like this. So next week, same exact idea, right? We've got this 96 strike call. Let's see, is that accurate? I don't think it's a 96 strike call that we have for next week. Let's take a peek at what we've got. 103 strike call. Okay, I was going to say a 96 strike call would not have been very smart of me to sell. But we've got a 103 strike call, right? Remember that we sold the 100, right? We started at 99 or 98. Backtrack, talking a little too quick here. We started a couple weeks ago at 97, got up to 98, rolled it higher again to 99. This past week we had 100, and now going into this next upcoming week, there you go, we're at 103. So we just keep moving that break-even target higher and higher and higher, and it now sits up here at 103 for max profit on the trade potentially. So we have that like 88 cumulative profit that we've had so far, and if we finally get the flush, we'll pull $207 from that to make $300 from the trade overall. Again, nothing crazy, but the idea is we stack a lot of these smaller trades on top of one another, and then cumulatively, when they all work together, they give us some nice weekly profits. We don't want to put all of our eggs in one basket. What's after win on here? Affirm. This is one that was a good example of why we like to take profits early in the week, right? We had this 14.5 strike call. If we go to the Affirm 5-day chart, it's going to look absolutely insane. Yeah, there it is. So we had these 14.5 strike calls. I believe we started small. We started with 5 contracts. After 14.5 got breached on Monday morning, we added 5 more, right? We added this 16.5 strike call, and that allowed us to scale into the trade. And we'll remember that with this initial 5 contract size, right, for 63 cents, if we had let these expire worthless, you know how much we would have made? $315. You know how much we did make overall? $355. So we ended up, thanks to giving ourselves the ability to scale into a trade, 1, we had a higher break-even price than we initially would have had, and 2, once we got the move that we were looking for, we were able to take profit early and pull more profit than the original max profit that we set out for. And why do we like to close trades like this early? The answer is because if we had held on to this 14.5 strike call that we closed out for 13 cents, Affirm finished at 16.24 last Friday. So this would have been worth like $2 and we would have lost 685 bucks, right? If we kind of undo and redo this here, that's like a $900 difference in our P&L for the week. So that is why we take profits early. There is no such thing as a guarantee in the market outside of the current prices that you're looking at that you could take profit on. And I guarantee you that if we had held out, right, we locked in 250 bucks of profit, there were only $65 more on the table. So if we had had a $900 swing over a 3-day period just because we were holding out for $65 more, that's where that idea of getting greedy comes into play. And I'd much rather leave the 65 on the table knowing we could lock in 250 than kind of hold out and wait and then have something terrible like this happen to us. But the great part, since we did take profit early, we were able to get into another bearish Affirm trade for next week. 16-17 call credit spread. Why are we using spreads? Just because this move from 12.86 to 16.6 is a little crazy. And further, the CPI happening next week, you know, Apple earnings, Amazon earnings, there's a lot of things that can move the market. So for a lot of the bearish trades we're in next week, we use some spreads, right? We've got a Tesla spread, we've got an Affirm spread, and that's kind of what we're rocking with for next week. But we'll talk about that in a minute. Moving further down the list here, this is probably where a little bit of regret slips in, right? We talk about taking profit on Affirm, how we did that really well. Lyft and CCL, Carnival Cruise Line, are 2 examples of trades where we did not do a very good job of that. I thought the 16 and the 11 strikes were generally pretty safe. If you take a look at Lyft, we've got another very similar 5-day chart where we thought when it was down at 1465 that there wasn't really a chance that it would go back up to 16. And even on Friday morning when it opened at 1526, I didn't think there was really that big of a chance that it would run 75 plus cents against us. But again, we were wrong. Things can always, always, always happen. No matter what you think, no matter how safe something seems, the only sure thing is closing that trade out. We could have closed this thing out for 4 cents, which, doing some math here, if this was 04, we lost 50 on the trade this week, but we would have made 180, so a $200-ish swing. That's something I regret. CCL, very similar chart here where it ran up a bunch against us, got back above 11. We had to roll it a little bit once it got to this 11-ish range because there was no extrinsic value left. It did fall back down to a point where we would have made profit on the trade, but here's what we did. We kicked it into next week, right? So when you do get these moves against you and you've rolled the trade, there's a little bit of regret because if you had held onto the trade, you would have been fine. But getting this move means that the trade that we have set up for next week, where we had 11 strike calls for this week, next week we have 11.5 strike calls. You're looking a lot better on that trade, right? So there's 11.5 strike calls. I think we've already got them open. I mean, they're already up, they're up a little bit of cash for next week as well. So that looks solid from that perspective. And again, we've rolled up, we rolled out, and we didn't do it for credit. I think we did it for, actually, we did this one for credit. Lyft was even money, I believe. But we had a 17-cent open and a 13-cent close, meaning that since we sold the new calls for 4 cents more than we closed the initial ones for, there's $40 more of overall profit we can make on the trade headed into next week. And since we rolled the strike from 11 to 11.5, we now make that money below this level way up here as opposed to this level down here. So just step by step, week by week, just continue to work that up. And CCL has been a good little short opportunity for us. This isn't the first time we've had it. We hit those 11 strike calls for the January 20 expiry as well. So while we did only make $10 last week, we're up 130 overall on CCL. With another potential 170 to come in, so that'd be another $300 on CCL. Again, just playing this idea that RSI is getting really, really hot. We've got really strong demonstrated resistance here. I don't think the company's that strong, so that's another thing we've got working for us. And another thing, it's not a hard to borrow stock. Example of that, ChargePoint. Ooh, it's not hard to borrow anymore. GameStop is not showing as hard to borrow either. For some reason, none of these are showing. Forget that point. I'll figure it out later. The beauty of a live stream. TSM, this was the one that worked really well for us. We got in. If we go to TSM, we'll take a look at that 1 year. We'll see that, boom, RSI was getting really hot. What happens after RSI gets hot? Typically things cool off or at least flatten out a little bit. That's exactly what happened. Sold the 95 strike call. We were in with $108 of profit. And that's another example of one of those smaller trades you just pad your account with. If the market's ripping up a bunch against your portfolio, just start scaling into more and more trades and you'll be good to go. DraftKings, another one of these strangles, albeit we only did it with 5 contracts. I think 2 weeks ago we did it with 10 contracts and it was fantastic. We made like $550 off it. We did half position size this week just to reduce risk a little bit. Still made $170 for us because it did finish between 14 and 15, but one of those where we took profit early, just to lock that in case something crazy happened. And I think DraftKings finished at 1504. There you go. So, was a smart move because it did run up a bunch at the end of the day. Microsoft, we played this off the bottom of the earnings. One good way to play earnings season, it can be tough sometimes to manage earnings trades because you're kind of guessing on a lot of different factors that are a little bit outside of your control. But one thing that I do like to do is if I see a solid company have a drop off after earnings to a level that I would like to own it at, that's a pretty good idea for entry on a position. So Microsoft, that happened, 227.5. And generally, with the amount of bearish trades that we had in our portfolio, was just looking to add more bullish trades, and that's a good way to do that. And we'll know that, the entire market basically ripped up last week. So even though if we go to the 5-day chart here, Microsoft did have this initial dip off of earnings, rebounded really nicely. Our strike was, 227.5, so that was never even remotely in any danger last week. So that one worked out really well for us. WBD, and this one's important because this is the biggest mistake that we made last week, and I think I would call it the biggest mistake that we've made so far this year. So let's talk about it. Biggest point here is that not every trade that loses is a mistake. but I think there were some mistakes about the way that we handled this one. So WBD is this stock where we're similarly following the idea that RSI has been running really hot. It's at 75.91 as of the end of the day on Friday. That's really large. The last time I got this high was, a couple weeks ago, which is why we started playing this on the short side, right? And after it did spike up, you can see that red right there. We got a big red candle and it went all the way back down below 12 a share. But very, very quickly it popped back up and it's chilling around the 15-ish dollar level. And we were playing it off this big candle here that we see on Wednesday. So you see this RSI get really, really hot again. But again, just because something's running up doesn't mean that it's going to stop necessarily. But we started with 14 strike calls that we sold for 16 cents. That gave us a 14.16 break even, which we thought would be relatively manageable. I think that was mistake one, because the issue is this isn't a ton of premium. And the other thing here is if you've got a stock that has these green candles like this and is really, really making some positive upward momentum, it's probably safer to just buy the 15 strike call and turn it into a spread as opposed to taking the naked calls. You'll notice we learned our lesson and did that afterwards with the 15-16 call spread and made $100 back off of it. But I think that's issue number one. Is it's okay when you've got something like a win set up where there are no massive green candles. It's just kind of a grind upwards. Whereas that's kind of stark contrast to this really steep WBD move, which doesn't look that steep until you zoom in and really see how large some of these green candles were. But buying the back end of that spread would have saved us a lot of money. The second mistake is we like to scale into these trades and double down. I don't think that idea is a mistake, but I think we did it way, way, way too quickly. Because we started with a 14 strike call for 16 cents a premium. That's a 14.16 break even, and it got above 14.16, this level right here, very, very quickly. It got to like 14.5, but I think when it was in the 14.3-ish area, we doubled down with 14.5 strike calls for 28 cents of premium. And the idea there is that, anything above 14.75, this trade was going to make us some money back. But, it kept running. And on Thursday morning, it got, above 14.7-ish, 14.8-ish. And at that point, I had to pull myself out of the trade. When I'm using naked calls like this, they are a little bit more dangerous because something like this can happen. So to mitigate some of the dangers, one, we want to, when a stock is more dangerous, use a credit spread. That was a mistake right there for me. Two, anytime we get to a certain loss level, and for me it was $1,000, I'm just going to pull myself out of that trade. At the end of the day, it could have gone all the way back down, and then I would have made max profit, and I regret it, yada, yada, yada. But regretting that is okay, because if things kept going, and we've seen stocks go insane before, right? If we go to the 3-year chart, it's not, unusual for this stock to make an insane move. So I wanted to pull myself out of the trade, because if we got on the wrong end of this with naked calls, you could like kiss half of my account goodbye. That would have been ridiculous. So I stopped myself out when I was at about a $1,000-ish loss. I saw that happen on Thursday morning. So I closed it out. 1,050. I think I closed a little bit higher, and it kept moving against me a bit as I was trying to close it. But that was the mistake, right? We should have used a credit spread because there wasn't a ton of premium, so it's very, very cheap. We would have sacrificed maybe $20 to buy the 15 strike call behind it, and we would have saved ourselves a lot of money there. And then, yeah, we should have used the spread, and we shouldn't have doubled down so quickly. But what we did do well is we stuck to our rules. We limited the loss. It sucks that we made that loss. That was a mistake, but hey, mistakes happen. It's not going to be the last time I make a mistake. But, when we do make mistakes like this, we want to make sure that we're learning something from them. Because if we don't learn something from a mistake, we're going to keep making the same mistakes. I will make more mistakes in the future, but I really, really try my best not to make the same mistake twice. And the idea of closing these out for a $1,000 loss and not letting the trade go beyond that is a lesson I've learned from a previous mistake. So I at least executed that part of it well and stuck to my rules, but still a lot we could have improved on that one. But again, we took that lesson. We made $110 back off of a spread. Keep the ball rolling. Capital One Finance, 117 strike call. Similar idea with RSI. This is going to be a 3-year, but let's go back to the 1-year chart. RSI 74.63. You'll see right here the very, very high number. Reaching this level as well, where if we extend this line to the left, what are we going to see? We're going to see that it's previously bounced off of there. So the peak of this candle is 118.4. if you go take a peek at where we peaked at, there we go, little homophone. It's 119.44, and it's starting to fall back down off of that a little bit. So falling back down off of this line almost exactly that we just drew, combined with really high RSI, I'm happy to play it short. And while it did continue to run against us a little bit, we sell out of the money calls. We've got premiums. We've got a little bit of a cushion just in case we're wrong. And that cushion worked out very well. And we rolled this thing into next week, right? We want to roll up and out for a credit. We had that 117 strike call. We rolled it to, where'd it go? A 119 strike call, and we closed it for 114. We opened for 166, meaning there's now 50-ish more dollars we're going to be able to get overall. So while we set out for $145 of profit here, the 31 we got on the initial trade combined with the 166 we potentially can get this week would put us at 197. And we, again, have a higher target at 119. So as long as it stays below 119 for the coming week, we are going to hit max profit on that trade. And then Intel, this brings us to a very, very exciting one that almost gave me a heart attack on Friday morning just because of how insanely the thing was moving around post earnings. Let's click on this. Let's take a peek at it. Boom, you've got this big red candle. We had a bullish trade, right? This is earnings, right? It's kind of a crapshoot. But if you have a stock that you like and you think you can get a decent price on, Intel pays a dividend. It's normally much more stable of a stock. Yes, you see it drop down from 52 to 24, but on a 3-year basis, this thing really isn't doing anything too crazy. And Intel, it's a profitable company. They're a decent company. Revenues are dropping a little bit, thus the big red candle. Earnings report wasn't phenomenal, but I don't think this is a horrible stock to own, right? Much better getting on the wrong side of something like this than, for example, being on the wrong side of something like an Affirm where it goes from 176 to 8. Like that type of risk does not exist on Intel unless they like shut their doors tomorrow for whatever reason. So we go here, what happened? We got this big red candle. We initially started with these 27.5 strike puts for a 26-cent premium. Let's go a little bit closer here. 27.5, that was our max profit level. We'll notice that it dropped below that and then popped right back up almost immediately on Friday morning. So we would have made max profit on the trade. However, where did it open at on Friday? It opened down near 27.1, and even at that level, I'm okay to wait it out a little bit. But when we started seeing 26.8-ish Friday morning, about 10 minutes after the market opened, that's when I said, okay, our break-even price, and let's remove this drawing here and kind of draw where our actual break-even was. Our break-even was the 27.5 strike minus the 26 cents of premium. That's a 27.24 break-even price. Let's go right there, 27.24, extend the drawing to the left, boom. So when we were decently below this, and at 26.8, you know, this thing was going to be worth about 0.7, so we were looking at like a $440 loss. So what I said was, okay, we need a way to move this red line down, because if Intel continues to move south, we're going to be in a little bit of trouble. So what I did was essentially turn it into a straddle, and after earnings are announced in the morning, typically there's a little bit of residual premium, and the 27.5 strike calls offered 28 cents of premium. So what does that do? Since we sold 10 of these 27.5 strike puts initially and was sold an additional 10 of the 27.5 strike calls, this 28 cents is a direct cent for cent reduction of our break-even price, right? So this 27.24, if we take away 0.28, our new break-even price was 26.96, which gets us 26.96 down here, much more manageable, right? We're down near those candles. So I said, okay, fantastic. If this thing wants to rip back up, which it doesn't make sense that it would rip back up super far, you know, we live with that because we potentially recoup all of the profit on the 27.5 strike put. And then we get a really nice sweet spot here at 27.5 where it finishes around there. We could potentially even hit max profit on both of these things. And boom, you've got like $500 of profit. Let me undo that so the profit's correct again. But what ended up happening, of course, you know, it rips right back up to a spot where we would have been profitable and hit max profit on our original trade. However, we had to do this at 27 or 26.80. You know, our hands were tied a little bit. We had to try to do our best to manage that trade. So while it did kind of move against us and went up above 28 at one point where we actually would have been max profit here, but we're losing on this side again, it like we started losing money on the opposite side because of how quickly this moved against us. But by the end of the day, the move leveled out a little bit. And once it got back down to this 27-ish level, We learned our lesson about profit taking earlier in the week. The last thing that I would have wanted to have happen was to have this thing rip upwards and then put us in a loss. So we had the opportunity, all things considered. Let me put that back. We had it move way against us. We were in a position where at one point on Friday morning, we were going to lose like $400, $500, $600 on this position. We had this point shortly after that where we were going to lose $300 or $400 on the upside. But early afternoon, we had the opportunity to close out for what would have been a $130 gain. And I said, you know what? I am perfectly happy to get out of this trade and make a profit because of how terribly it went for us. And it's a great example of how we can use option premium like this to our advantage, right? We had this trade move so significantly against us twice in one day, and yet we come out of it with a $130 profit. That is a big testament to how option premium and these option selling strategies can really help us manage these trades and still pull cash out, even if things are moving against us a little bit. And then the last thing we have here for our weekly recap is this XSP strangle, right? We started with the 401, 408 strangle. If we go to XSP, we might have this plotted on here already, maybe not. So the 401, 408, we know that our max profit would be between 401 and 408. It got outside of that range. Excuse me, we started with 393, 401. This was our first trade. I was going to say that didn't make sense. So our max profits between 393 and 401, we sold that for 359, meaning that even though 393 and 401 are our max profit range, you subtract 359 from this, add 359 to that, and our total profit range is like 390 to 404. So roughly here and down here. And it stayed within that range for a good 3.5-ish days, right? But once it gets above this, what we want to do is let it breathe for a second, right? Because the idea is if it's pressing upwards, 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 it's building up all this upward momentum, it's probably going to cool off a little bit. Now, it didn't cool off until the end of the day Friday, but we waited a little bit here, and then what did we do? We added another strangle to manage. That's when we added the 401, 408. And the idea here is you put this put strike right on this call strike. So if this put starts losing money for you, you know that you're going to recoup every single dollar that you're losing on that 401 strike, and that this strangle is going to hit max profit, and basically you just have to break even on this one to make money on the trade, or max profit, your original max profit. But since we've got a 1.81 credit, what does this mean for the high side, right? It means that our original break-even price of 404, we're going to add about 181 to that. So 404.5 plus 1.81 is like 406-ish. So then our break-even price gets moved from here up around here. And we did not quite get back down there. We lost about $166 on XSP this week, which is, you know what? That's okay. Because the market absolutely ripped, right? These weeks are not typical. They happen sometimes. And they're going to ruin strangles like this when they happen. But the fact that we could minimize that loss, only walk away with the $166 loss on XSP is fantastic. When losses happen, we want to limit the magnitude, and we did that very well. If we go back to this tab where we've been tracking this, you'll see those two right there. That's our 166 loss. But even with those, we're on track for $1,205 of profit on this strategy, which has been operating really, really well for us. And there's this rule, right? So if we get breached twice on the same side, right? We know that we started with a 393, 401 strangle. So we got breached on 401, meaning we got breached on the high side. If we get breached again on the same side, meaning breached again on the high side on 408, we're going to want to roll that into the next week. Why is that? Because if you get breached on the high side and then roll up and get breached on the high side again, we love that idea of RSI and the momentum of the market getting a little bit overbought. It's going to fall back down. So what we do is instead of just closing these out and taking a loss, we're going to roll the 408 strike call into the following day. You're going to get some extrinsic value, and you're also going to still hold out for the benefit of if it falls back down on you. And if it does fall back down below 408, we're going to make $221 from this. So even though the overall position for last week lost us 166, just rolling this 408 strike call can recoup 221 and actually put that position in profit, provided that it just finishes below 408 now, and it is currently sitting there. So you'll see the idea behind this and how this works, right? We start with this break-even price here. By adding another strangle, we get it up here. By rolling the breached leg, we get it up here. You know, the market, in theory, can keep going up forever, but in practice, it really doesn't. It moves in more of a wavy type pattern. So if we get that wave just back down below this 408 level, even though both of these initial break evens we had have breached, we now have an even higher break even just for Monday, just for tomorrow, where if it's below 408, we are now making money overall on that, which is fantastic. Additionally, we've got this, where is it? The 408 call that we hope to make 221 off of. And then we've got another strangle that we opened. And I believe I'm going to have to check the strikes on this. 406 and 410 for the coming week. And one thing that I want to point out is that the expiry, typically we want these to expire on Friday. We do this for a whole week. We do not want that. CPI is on Wednesday, or not CPI, excuse me, FOMC, where they announced the rate hike, is on Wednesday. That's a very large potential bullish or bearish. It's a very large volatile event is the word I was looking for. If we remove our drawings here, we could, I guess these are brand new. I'm going to have to manually remove them. All right. So what we saw was we had 406, we had 410. So we know that our max profit range is between 406 and 410 for the new strangle. But we remember that when we sell for a credit, we add that to our break-even range. We have a max profit range and an even wider break-even range to where we'll make money, period. So if we had 267, that's going to put us at 412.67. And then if we take away 267 here, it's going to put us at like 403.23, 33. Close enough. So boom. Anything, if we remove this drawing and remove this drawing, if XSP finishes between these two lines by Tuesday afternoon, we are going to make money on that new strangle. But again, if it doesn't happen, we're probably going to cut this trade off. We know that we like to roll, like we just demonstrated, and add new strangles to manage. However, one of the other rules, and probably the most important rule for these XSP strangles, is to avoid expiry dates that have significant market news, whether it's FOMC, CPI, etc. But again, we've got FOMC Wednesday. So we've got this new strangle expiring on Tuesday, January 31st, the last day of the month. So we hope that it finishes within these red lines. We hope it finishes within an even tighter range. But the way that we've got things set up, we're going to be entirely out of these XSP positions for Wednesday's FOMC, and then we can react from there. But let's talk about the other things that we have. You know, this has been going really well for us, and I'm going to 127, 23. Oh man, I've been putting 2022 as all these dates. Whoops. I'll fix that later. But if we put this new strangle in, we will see, bear with me. Copy this down. That are, let's see, -1. $267 is what we'll pull from that, and then our total P&L will be up to 18.4%. And what we do know about this is that there is $8,000 of collateral, but you can also use MES instead of XSP, where collateral would be $2,000. And of course, that looks like a much better return at 73.6%. But of course, if it does turn against you, the loss numbers get larger as well. But in the interest of being conservative, we use that 8,000 collateral number. It doesn't require 8,000 if you want to use MES, but for transparency and how these numbers are being calculated, this is how that works. But average return, 1.67% per week. And this has been happening where the market has had some very wild swings, right? The market has been moving up a ton. So in theory, these things should be getting breached all the time. However, we've managed to still have a profitable run. So once it starts calming down a little bit, these things are really hopefully going to start to pull some decent profit on a weekly basis. Okay, pause. Let's get into what we've got for the coming week. We've got $1,743 of base potential profit. What does that mean? That means if none of these stocks move, and I've got this weird dot here that, why is this dotted box here? That's very strange. If I click off the tab, does it go away? Whatever, we're gonna live with the dotted box. Really weird. However, $1,743 is our projected base profit for the week. Again, what does that mean? If the stocks don't move from where they currently are, we're gonna make $1,743. What we do have for the coming week are overwhelmingly bearish trades, right? The market is running up a ton. If we go to the market watch, go to the S&P 500 sectors and sort them, we've got two different sectors now that are above 70, meaning very overbought. The S&P 500 itself is at 63.84. If we go to the SPY chart, go to a 1-year basis, very rarely does SPY itself get above 70. It's happened once in the past year. And when it did happen, when it got to like 72, 73-ish, we went from 432 in mid-August down to 348 in early October. So there was a massive slide. So anytime RSI starts getting up here a little bit, even it didn't even have to get up to 70, right? These similar levels here. We saw a drop from 462 to 387. That's a massive dip. But again, could we keep running up through here? Absolutely. But we've got some volatile events that are either going to break us through, in which case we could then add more bearish positions because it's going to cool off at some point. Or it's going to start the next downtrend in the market. We did break through the initial downtrend, but look, if we have a 2 or 3% red candle in the S&P 500, we're going to be right back below that line, slipping back down. But all things to keep in mind. So we've got some bearish trades. We talked about when, and a thing to point out about these trades individually is while the S&P 500 RSI is a 63, all of these individual positions have RSIs that are even higher. So while the market as a whole we think is going to come back down, these stocks independently have an even more bearish case to come back down, right? We looked at WIN. What's the RSI on WIN? It's at 72.58. CCL is sitting at 66.83. Lyft, what is Lyft sitting at right now? Lyft is at 74.86. That one's very, very high. Intel, we've got that one. That's a neutral one. That's a strangle. It's a 27.29 strangle. So that same idea we were playing with XSP, where we wanted to sit between a certain range, and then we have an even wider break-even range. We've got that on Intel because Intel historically is a little more stable of a stock. And the reason that I like using some strangles here, like we did with DraftKings over the last couple weeks, is I'd be happy to initiate a bullish position if it gets breached on the downside, right? We'll notice that these 27 strike puts we sell for 43 cents means that if we're assigned, we'll have a starter position at about $26.57 basis. So if we go to the Intel chart, we go to the 10-day-ish, and where's 26.57? 26.57 is way down here. It never even got that low this past week. So if it goes down below there, I'm perfectly happy to take assignment on a half-size position, right? We sold 5 of these, 10 would be full. We always want to leave some money in our back pocket to scale in. But happy to take assignment down there and then potentially double down to get even lower. And then on the high side, if this thing runs back to 29.43, I'm happy to play it back down because it was trading near 30, had a bad earnings report. So in my mind, it should be worth less than 30 a share. But moving down, and again, if it stays in that range between 27 and 29, decently wide range, we're going to bag 215 bucks. That's the way we like to do it. Capital One Finance, another one where there's a really, really large RSI number. We go to the 1-year chart on this. We see that it's sitting at 74.63 right here. That's a massive, massive number, coinciding with where we see some resistance as well. So happy to continue that one for another potential 166 bucks. And then Affirm is one that we talked about earlier. Some of these riskier stocks like Affirm, which flies around a ton. You know, you see a range from 83.57 down to 862. This thing's basically doubled in the past month. I've got a little bit of a theory that a lot of these stocks where there were such significant losses, right? A lot of people lost money on Affirm in 2022 and sold it to harvest those losses. In order to avoid wash sale rules, you have to wait about a month when you sell those things to rebuy them. So I think a lot of this January strength that we're seeing in some of these growth stocks that sold off so heavily relates to people who still like the stock but sold it in December so they could have the loss for tax purposes, but are now rebuying in January. So we've seen it literally double, which is crazy. And look, it can absolutely go higher, which is why we're using a credit spread because we have defined risk on the position. Most we could lose on this thing is it can go up to $1 and we could lose 790 bucks. And if it happens, you know what? It happens. We want to limit our losses to like 1,000-ish a piece if they get really, really bad. And we can't even get up there. But as it currently sits, Affirm closed at 16.24. This would be worth 0.24. So we'd be about at break even. And what's annoying about this one is I think we opened this thing with Affirm at about $15 a share on Friday morning. So the cushion that we had basically got entirely used up before the end of the day. But again, that's why we use those cushions, right? This is why we use spreads, because in case we were wrong, which we were, we've still got a little bit that it can move against us, and we'll be just fine. And if it falls back down and cools off a little bit, goes back below 16, finishes anywhere below 16 in the coming week, boom, that's 210 bucks of profit for us. IBM 133 strike put. Another one which is a little bit more stable of a company, had bad earnings, but that's not the worst thing in the world. So we sell the 133 strike put. We get in down here. We get $1 of premium on it, meaning our break-even price, the price that we would be assigned on these shares at, is going to be $131.93. And where does that sit? That's all the way down here. So we've got a really, really nice cushion on that one headed into the week on a bullish position. And again, we always want to have a couple bullish positions. IBM is one this week, and you'll notice the other one we have here is Lucid. And I love the opportunity to talk about this because it has been so long since we've had one of our favorite IV reversion type trades. Now, this strategy is one that has gotten us a ton of cash. Of the little strategies we play within option selling, I think this one has been by far, the most profitable, highest hit rate. And I was really, really excited to see Lucid. And we have a potential profit of $460 on that one this week, which is the largest potential profit. So why are we scaled so heavily into Lucid right now with 20 contracts? What do we like? What have we seen? Let's talk a little bit about it. So if you were watching on Friday, there was a little bit of a rumor that the remaining stake that the Saudi Public Investment Fund owns in Lucid was going to be bought out. Whether or not that is true, I have no idea. But what happens when these things spike up? You see this massive spike in implied volatility. And just to put into context how big this spike in implied volatility is, take a look at that. On a 180-day basis, a stock like Lucid, which has been pretty volatile in the past, basically surged. I mean, it almost doubled in implied volatility. And it was caused by this big spike on what would be conceivably good news. So there are a few different check boxes that we want to check when we go for these IV reversion trades. The first, is there a big spike in the price caused by good news? The answer here would be yes. The second, is there a subsequent surge or corresponding surge in implied volatility? The answer is yes. 3, are we able to sell a put from where the stock took off from? The answer was yes. Right? So if we look on a 5-day basis, where did this thing take off from? It took off from about $9-ish a share. So the idea behind this is that implied volatility is massive right now, so it kicks up all the option premiums. But even if this rumor turned out to be false and all of the gains from this spike were erased, where does it fall back down to? Conceivably, to me, it falls back down to 9-ish, right? Right where it took off from in the first place. So the idea is we go in a strike right below that. So if this turns out to be false, Lucid collapses next week and goes back and erases all of these gains from Friday, guess what? These 8.5 strike puts that we sold are going to hit max profit. And even if it doesn't, it goes back down to 827. We're still breaking even at 827, which is here on the chart, which is really, really nice on like a 5-day basis, right? It was basically trading above that for the entire week. And again, this trade that we have that expires next Friday on February the 3rd, this trade is on a 5-day basis. So there you go. We've got a really, really nice, something really, really bad I think would have to happen to Lucid. And of course, those are, famous last words. But one thing that I do want to point out, if we go to these, and I've got to zoom out a little bit for our strike. If we pull up the chart, you'll see exactly how the price on these kind of works. So this is the actual chart of the value of these Lucid puts. And if we stack this one on top of another with Lucid's actual chart on a 1-day basis, let's get it back over here. There you go. So you've got this massive surge. And what you'll notice is, early in the day, these things were trading. If this candle wasn't here, this chart would look a little bit better. Let's actually, whatever. These things were trading for about 20 cents early in the day. And again, early in the day, what was Lucid at? Lucid was at $9.22. But what's crazy is that when Lucid gets up to 17 and has doubled in price, right? In theory, which is what this purple line plots, if the price of a stock goes up, the price of a put should go down. But that's not what happens. That's not what happens here when implied volatility spikes up as much as it does. And what you'll notice is that they go up from 14-ish cents and they peak almost at 30 cents a piece. These things almost doubled in price despite the fact going up. So while in theory, the price of the option should be going down, we'll notice that due to the extreme surge in implied volatility, the price of the option is actually going up. And more often than not, even though it fell back down from 17.8 to 12.1, the fact that it just settled off at the end of the day, these things go from the mid to high 20s down to 15 cents a piece at the end of the day. So that's the idea there. We started, I forgot what we sold them for initially, but we started with 10. They went up even higher, and we sold some more for 25 cents a piece. So our average price on these is 23 cents a pop. And again, so long as Lucid stays above, if we go back to the Lucid chart, and didn't do this side by side, come on. Again, so long on a 5-day basis that Lucid stays above this red line, we're going to be bagging about 460 bucks on that trade. And then we've got the XSP strangles that we talk about. And that's it for the week, right? 1803 of base profit. But again, we've got this overwhelming concern that we think the market's going to be coming back down. So a lot of bearish trades. And if the market keeps running on us, so be it. It's definitely going to hurt us a little bit from an outperformance perspective. But we really, really want to remember the start to the year that we've seen from something like QQQ, which is effectively NASDAQ. This is not normal. And if we go on a 1-year basis, right? QQQ, the tech ETF, which is effectively NASDAQ, it has not been above 70 once. The last time it got close, massive dip. Time before that, massive dip. It's now higher than it's been on a 1-year basis. It's sitting at 68.54. So running into resistance here, high RSI, volatile event where we've run up into it, and I think it might be a sell the news event with FOMC. We've got Apple earnings where we know that they've already cut production in China. We've got Amazon earnings where I think they've had some similar headwinds. Next week is shaping up to potentially be a very bearish week in the market. So we want to, at a base level, I want to hold all these until Wednesday. And when I say that, I don't want to add any positions here because adding positions is adding risk. And yes, it would suck if the market ran up a bunch and we underperformed again, but that's a good problem to have. If we could continue, even if, it goes against us again and we only make 116 bucks next week, the biggest thing to making long-term progress in our portfolio is avoiding the big letdown weeks where we have big dips that take 2, 3 or more weeks to climb out of, right? If we take a look at 2022 as a little bit of a guide for that, it was great when we were churning out, 2000, even 54. That's a win because the market was going down. We were underperforming by a lot, but even when we started focusing a little bit on just making money every individual week, not trying to ride the market too hard, that's when we started to pull away from the larger indices and smoothed out the profit a little bit and really, really got away from these, heart-stopping, volatile weeks. So that's the approach here. Keep it small. The market's going to come back at some point, and when it does, that's when we're going to use that opportunity to scale back into a wider range of bear or bullish positions and go on from there. But we want to protect ourselves if the market goes down, and we've done more than that. We've put ourselves in a position where we're going to benefit pretty greatly if the market goes down. Tesla is another one I don't think we've talked about. But basically, this is a 50-50 bet on a 1-year basis. RSI, absolutely massive on this one. Similar trends, right? When it gets into this red area, we see it come back down not only once, but twice right here. This is basically a 50-50 bet that Tesla is going to finish next week below 170. And if it does, we'll bag $250. And if it doesn't, we've lost $250. And since Tesla is currently above 172.5, our max loss point, we've got that in there as the max loss to be more conservative. But if that flips around, if a firm flips around, we've got decent upside of like $2,500-ish of profit, which is above that 1% target we like to look at. And to be honest, with how many bearish positions we have, if we pull a $2,500 profit in a week when the market is moving down at a significant pace, that's going to be really big for us from an outperformance perspective. So that is the game plan for next week. But all in all, a successful January. A little bit bittersweet the way that it finished. We had a pretty big mistake. I think on Wednesday morning we could have closed everything out and been in the clubhouse with the $2,000 gain for the week. But hey, good lesson to be learned in profit taking. Good lesson to be learned in chasing some of these more dangerous stocks without spreads. The idea is we want to use spreads. But happy with the way January turned out. I'm never going to be upset at an $8,000, $8,500 profit in a month. Yes, we underperformed, but if we keep doing this, right, the big takeaway we want to remember about our trading so far in January is we didn't make this return because the market went up, right? In fact, we've got an overwhelmingly bearish portfolio right now. We made the return we did because we stuck to our rules. We followed our process. We identified good targets to play back down with RSI. We identified good bullish entries as they presented themselves, and then we made our profit that way. So we weren't dependent upon the market. And, the market isn't going to do this every single month, right? S&P 500 is probably not going to go up 100%, and NASDAQ probably isn't going to go up 200% over the course of 2023. But we will see the benefit of that. It's easy to get a little bit impatient when stuff like this is happening, when we do all this work and we slightly underperform, but we're comfortable in the long run that what we're doing is working, and we are going to see the benefits of that when the market either flattens out or starts to pull back a little bit. So stay patient, trust the process. I'm sticking with what we're doing, and that was the game plan for the coming week. Very, very short stack, and if possible, if we do get a little bit of a sell-off before FOMC on Wednesday, I'll do exactly what we did a few weeks ago with CPI. I'll just close everything out and we will go 100% cash into Wednesday afternoon, having zero risk, potentially a profit on the week locked in. And that is potentially a very good place to be if we can get there on Wednesday. So that's the game plan. Let me flip back to the webcam, and that is the end of our stream. So appreciate those of you who tuned in at the early start time on Sunday. Had to get it out of the way. I'm a big Niners fan, so we are going to be watching that one in a couple hours. Kind of nervous about that, but looking forward to an afternoon of football and a good upcoming week of potential volatility in the market, right? We've talked about how we've taken a bearish approach as the market has continued to run up. Yes, it can get a little bit frustrating when that move upwards is against us and leads to some underperformance in the short term, but I believe we've demonstrated how scaling in, playing these reversals and trends can really benefit us, provided we do it safely and effectively the way that we have so far. A couple mistakes so far this year. It happens. Hopefully those are one-time mistakes. But anytime we can take home $8,500 in a month, I'm very, very happy with it. But until next time, this is about all we've got. I'm excited about our plan for next week and excited, for next month, the rest of the year, and to see how this strategy progresses, beyond this year. Because it's not a get-rich-quick thing we're doing. It's small, consistent, compounding returns that are going to lead us to outperformance and success in the long run. There's no shortcuts in the market. We're not going to turn $1,000 into $10,000 in a month, but the idea is hopefully we could turn a good amount of money, and then through some personal finance habits as well, which we don't track. We just track our base amount. But if you're consistently putting away a certain amount of money into a brokerage account every week or every month, that's another really, really great way and consistent way to grow that account on top of your investing returns. But yeah, I think that's all we got. Until next time, this has been the Hourglass Trader, where as time passes, we make money, and hopefully we will talk again back at our normal time next week with more money in our account than we have right now. Appreciate all you guys who have tuned in. We're going to be in our Discord server actively during the week, hourglass-trader.com. There will be a big button in the middle if you want to join in that Discord server and chat with us during the week. But yeah, I think at this point I'm kind of just talking in circles. That's all we got. Thanks for tuning in, and we will see you guys in a week.